Financial markets follow patterns that traders can take advantage of using structured strategies. Two of the most widely used approaches are trend following and mean reversion. Trend following focuses on capturing large price movements in a single direction, while mean reversion capitalizes on price corrections when assets move too far from their historical average. By understanding these strategies, traders can adapt to different market conditions and improve their decision-making. Before we explore specific trading strategies, it's essential to understand how asset prices move in the market. Markets generally exhibit three types of price behavior. In trending markets, prices move consistently in one direction, either upward or downward. Range-bound markets fluctuate around a mean level without a clear direction. Lastly, volatility and noise refer to short-term price fluctuations that may not indicate a definitive trend or reversion. Recognizing these patterns helps traders choose the right strategy for different market conditions. Trend following is a strategy based on the idea that prices moving in a particular direction will likely continue in that direction. Traders align themselves with market momentum and stay in the trade until clear signs of reversal emerge. This approach works across various asset classes like stocks, forex, and commodities, performing well in directional markets but struggling in sideways conditions. Common indicators used in trend following include moving averages, which identify long-term trends, MACD, which measures trend strength and potential reversals, and ADX, which helps determine if a strong trend is present. By using these tools, traders can effectively capture and ride market trends for profitable opportunities. Trend following is a trading strategy that capitalizes on sustained price movements in a particular direction. Traders use indicators like moving averages, as shown in the chart, to identify and ride these trends. The green and gray lines represent different moving averages, helping traders determine entry and exit points based on trend momentum. This strategy works well in directional markets but can struggle in sideways or choppy conditions. By following trends rather than predicting reversals, traders aim to maximize profits while minimizing unnecessary risks. Mean reversion is a trading strategy based on the idea that asset prices tend to move back to their historical average after deviating too far in one direction. This approach works well in range-bound markets, but struggles in strong trends. Traders use indicators like Bollinger Bands to identify overbought and oversold conditions, RSI to detect when an asset is overextended, and moving averages to observe price deviations. The goal is to profit from price corrections as assets revert to their equilibrium. This slide illustrates an example of the mean reversion strategy in action. The chart shows Bollinger Bands, with price movements oscillating between the upper and lower bands. When the price moves too far from the average, it tends to revert back, creating trading opportunities. The RSI indicator at the bottom helps identify overbought and oversold conditions, signaling potential reversals. This slide compares trend following and mean reversion, two widely used trading strategies. Trend following works best in trending markets, aiming to ride price trends by buying high and selling higher. In contrast, mean reversion is effective in range-bound markets, profiting from price corrections by buying low and selling high. While trend following can lead to higher drawdowns but large wins, mean reversion focuses on frequent small gains, but carries the risk of prices moving further from the mean. Traders use different indicators for each, such as moving averages, MACD, and ADX for trend following, and Bollinger Bands, RSI, and moving averages for mean reversion. Choosing the right strategy depends on market conditions. Trend following is most effective when markets show strong directional movements, such as during bull or bear markets and breakouts. On the other hand, mean reversion works best in sideways or range-bound markets, where prices oscillate within a defined range. Some traders adopt a hybrid approach, switching between strategies depending on volatility and market trends. This example demonstrates trend following in the stock market using Apple, AAPL. A trader identifies an uptrend by analyzing the 50-day moving average and enters a buy position as long as the price remains above it. The strategy relies on momentum, assuming that the trend will continue. The trader then exits the position when the price closes below the 50-day moving average or reaches a predefined stop loss. This systematic approach helps traders manage risk while maximizing gains in trending markets. This example illustrates a mean reversion strategy using Tesla, TSLA. A trader observes that TSLA's price has moved significantly above its Bollinger Bands, indicating a potential overextension. To confirm this, the Relative Strength Index, RSI, is checked, showing a reading above 70, signaling overbought conditions. Based on this, the trader takes a short position, expecting the price to revert back toward its mean. This strategy aims to capitalize on price corrections when assets deviate too far from their historical average. While both trend following and mean reversion strategies can be profitable, they come with risks. Trend following traders face challenges like false breakouts, where entering too early or too late results in losses, and whipsaws in sideways markets, where price fluctuations lack direction. On the other hand, mean reversion traders risk getting caught in strong trends that never revert, leading to continued losses. Additionally, black swan events, such as sudden market crashes, can disrupt mean reversion trades entirely. Effective risk management, including stop losses and proper position sizing, is essential to navigate these pitfalls successfully. Building a strong trading strategy requires a structured approach. The first step is to define market conditions, determining whether the market is trending or range-bound. Next, traders should use fundamentals to identify potential stocks and choose the right indicators, such as moving averages for trend following and RSI, or Bollinger Bands for mean reversion. Effective risk management is crucial, including setting stop losses and adjusting position sizes to protect capital. Finally, traders must backtest and optimize their strategy using historical data before applying it in live markets, ensuring better performance and risk control. In conclusion, trend following and mean reversion are two essential trading strategies that professionals use to navigate the markets. Trend following capitalizes on strong directional movements, while mean reversion profits from price corrections. Both strategies have their strengths and risks, requiring traders to adapt based on market conditions. Successful trading involves not only identifying the right strategy, but also incorporating fundamental analysis and risk management to improve decision-making. Mastering both approaches provides traders with a flexible and profitable system, allowing them to thrive in various market environments.